Welcome all to Equity Learning Module 5, EOC Qs, which are kind of interesting. Let's just have a quick review of them. There's really not much here, and a couple of interesting things to look at. We have one scenario and a few questions based around it. Let's first of all read the scenario. Joshua Hu, a research analyst, is initiating coverage on several companies in the ocean freight shipping industry. Old Ships, so here we go. Here's the first one to look at. It's Old Ships. Is a mature company with high fixed costs. Now, as soon as I see that, I'm thinking, okay, Old Ships, what do we look at in this learning module? High fixed costs. High fixed costs increases my operating leverage, increases risk. Now, what are we told down here? For Old Ships, degree of operating leverage, 1. Doesn't really tie in, to be honest, so I'd kind of ignore these. I don't think they add to our understanding at all. What I do is replace those and say for Old Ships, just to help us later on, let's say we have the net margin. And let's say the net margin for Old Ships is 2%. And for Clean Yards, the net margin is 4%. I just don't think the way the leverages are set up in this scenario really makes sense. Has a high capital expenditure to sales ratio because it owns and operates its own fleet of ships. Okay, a lot of assets there, big asset base. Clean Yards is a technologically advanced, sustainable shipyard with a focus on specialized repairs and ship construction. Okay. Who has compiled the following data for the two companies? We're ignoring whose leverage. Asset turnover ratio we have. Okay, and then DSO, DOH, and DPO. These would be good for a cash conversion cycle. New Ships, a third company, is web-based shipping technology platform that connects ship operators such as Old Ships with customers in a wide variety of industries who need ocean freight shipping. So New Ships is online. They are going to be asset light. New Ships customers place orders online and pay for freight to be placed on a container to any destination in the world. New Ships partners like Old Ships provide vessels on both long and short-term charters. In 2019, New Ships platform brokered orders for 900,000 20-foot equivalent units, TEUs, containers in aggregate, with an average gross freight rate of 3,848 per TEU. On average, a New Ships commission, which it receives as a broker from the customer, was 6% of the freight rate. Okay, was it though? We shall see. And then we have the questions. Here we go. Which of the following is most likely to be an element of whose subsequent reports? Industry size, growth rate, and key drivers. Summary of changes to the recommendation and ownership structure and management composition. And really, obviously, this has to be subsequent reports. If you change your recommendation, that goes in a subsequent report. This is really kind of initial report information. Yes, if it changes, it will be mentioned, but these look like the basics in an initial report, so I can go for B there. Shipping is a highly cyclical industry. Which of the following companies most likely has the most ability to ramp up capacity to meet increased demand for shipping services? Well, Old Ships, mature with high fixed costs, high capex, its own fleet, going to be difficult to buy new ships quickly. Clean Yards is a shipyard, technologically advanced, sustainable shipyard, specialized repairs and ship construction. You will need specialized staff to ramp that up. Is going to be pretty tricky. New Ships is web-based. We said it was asset light. It's going to be New Ships for sure. In 2019, New Ships revenue was closest to. We have information on revenue here. They are simply asking us to multiply together three numbers. How difficult can that be? 900,000 TEUs at 3,848 per TEU at, so there's those two, 6%. That will give me 207.8 million. So as it turns out, from my bravado, it is actually quite difficult to multiply those three numbers together and get any of these three answers. If, on the other hand, I change this to 5% and this to 5%, I get 173.2 million, which would tie into A. So they are using 5% in the answer. Unless I've missed something, can't see in there where the 5% comes from. I presume it was just meant to be 5 instead of 6. Assuming both companies have similar equity multipliers, Old Chips is most likely to have. And we're comparing ROE to clean yards. Right, I've got to try and get to ROE. What I have is the equity multiplier, which is the same. If I go back to my information, I also have the asset turnover ratio. So I think, aha, I can see what's going on here. I can use DuPont to get back to my ROE as long as I have the net margin, which I don't. So I'm going to scratch out, as I mentioned earlier, those leverages because they're not useful. I don't think they're realistic either. And give myself some net margins to answer this question. 2% for Old Chips and 4% for clean yards. Now, if the equity multipliers are equal, that is not going to be a reason for a difference in ROE. If I then compare Old Chips and clean yards, Old Chips net margin I'm saying is 2%. Clean yards is 4%. Asset turnover for Old Chips, 0.84. And asset turnover for clean yards is 0.42. Multiplied by the same number, given they're equal, let's just call them 1. The easiest thing to do. That would give me 0.0168, 1.68%, and 0.0168%. What we're doing here is saying Old Yards has an asset turnover, which is double that of Clean, but Clean has a net margin that's double that of Old. They would be similar. Now, clearly, I've answered my own question there because I put in the net margin. And what the answer does is try to go through these degrees of leverage to break down ROE, which is interesting, but best avoided, I think. So I'm going to go for B there. When conducting company analysis, which of the following is least relevant to determining a company's business model? Company annual report describing the firm's product lines, that would be useful. Comments by management about competing products and substitutes, I would also say could be useful. Industry white papers regarding the company's product pricing strategy, also useful. So the annual report is going to tell you for sure useful information about product lines. The industry white paper will be a good source on their pricing strategy. Comments by management, I guess we could be slightly dubious about in terms of their views on competing products and substitutes. It would give you some information, but I guess you could argue we should do it ourselves separately, and that could be the least relevant source. But I'm leaning there on the word least to come up with that answer. Old Chips cash conversion cycle is... So we've got to compare Old Chips and Clean Yards cash conversion cycle. Well, here they are. DSO plus DOH minus DPO. So a simple bit of math there. -16, 104. So Old Chips cash conversion cycle is very much lower than Clean Yards. The first step in reviewing a company's capital investments is to evaluate management's investments, identify operating cash flow drivers, useful things, but are they the first step? Determine the major sources and uses of cash. You could argue that it's sensible to start there, see where the sources and uses of cash are, before we then go on and see what's driving it and how they choose to invest. So you could go for C in there.